Got a couple Wall Street articles to do. More signs the economy is not as good or strong as maybe we thought. Um, Australia, I think it started with the Webbot thing a little while back that talked about watch Australia, housing market, the same scams and things we dealt with over here, they're got over there. But it seems like I've seen a few more things lately and put the country of Australia in the spotlight, and it's related to housing. Here's another thing. Severe collapse of home prices might trigger a financial institution crisis in Australia. The OECD frets about the banks. The authorities should prepare contingency plans. The big four banks are too exposed to mortgages. Even if the banks don't topple, the economy will get hit hard. In its latest report on Australia, the OECD focuses to a disturbing extent on housing, household debt, what the current housing downturn might do to the otherwise healthy economy, and what the risks are that this housing downturn will lead to a financial crisis for the big four Australian banks, an eventuality that it says authorities should make contingency plans for. Now, is that the same thing as we need a bailout? Going to bail out the banks again? We have like JP Morgan, Bank of America, Goldman Sachs, Citigroup, what's the other one? The other one, the criminal one that's constantly in the news now. Not Goldman, Wells Fargo. They all got bailed out. Well, Australia has its four big banks apparently too. The four big banks are huge in relation to the Australian stock market and the overall economy. Their combined market capitalization at $341 billion, even after today's sell-off following the OECD report, accounts for 26% of Australia's total stock market capitalization. How they dominate the stock market showed up on Monday after the release of the report. So we got the Commonwealth Bank of Australia down 3%, Westpac down 3.3%, Australia New Zealand Banking Group down 4%, National Australia Bank down 2.54%. The overall ASX stock index on Monday dropped 2.27. Can you see what's happening though? Our markets are down, Australia's are down, these other countries are down, cryptos are down, everything's down. And as I read that Q thing earlier, which would be last night for you guys, and Q's talking about, the Fed, they plan on really doing some rate hiking around March of 2019 so they can destroy the economy so that when President Trump goes to run for re-election, he's not going to get the nod because the economy is going to be crap. However, as Q said, we are well aware of it and know about it in advance. So get ready for some policy change or some changes at the Fed, basically. But continuing on, these big four are heavily owned by Australian pension funds. Oh, you don't say. Where have I heard that one before? Oh, you thought that was an American-only thing? Oh, no. These big four banks are heavily owned by Australian pension funds. So when Australia government comes out and says, guys, we got to bail the banks out, and everyone's screaming, no, we can't do it again, your pensions rely on this. You sure you don't want us to bail them out? Well, my pension, And the pensioners will vote. They'll vote to say, you know what? Yep, go ahead and bail them out. Go ahead and bail them out. Don't worry about it. Where was I? So a banking crisis. These big four are heavily owned by Australian pension funds, retail investors, and the like, and form a big part of the retirement nest egg of the nation. So a banking crisis that involves the big four matters on all fronts, and the OECD report even pointed out that a collapse in the share prices of the big four would itself impact the overall economy negatively. The report, which is in PDF format, and they have a link over at Wall Street here, starts by explaining just how strong the economy is in Australia. With 27 years of positive economic growth, Australia has demonstrated a remarkable capacity to sustain steady increases in material living standards and absorb economic shocks. The labor market has been equally resilient. That word resilient was used a lot. I remember Bush Jr. was using that. Obama, our stock markets are resilient. Our banking system is resilient. Our country is resilient. I mean, maybe they were using that word a lot. It's interesting how you could use that when I guess we weren't so resilient after all. Housing crash, $5 trillion on the Federal Reserve balance sheet came out of nowhere, bailing out overseas banks, bailing out our own local banks, $900 billion TARP fund. Our $10 trillion debt turns now to $22 trillion 10 short years ago. Or 10 short years later, I guess I should say. So Australia is trying to say the same thing. We're resilient, the banking system's awesome, but just if the stock market goes down, oh, it could have a negative effect on the whole economy. Well, how did you have resilience for 27 years? It expects continued robust growth of around 3% in the near future. And the OECD's resilience, they have a resilience indicator. What? The OECD's resilience indicators, it's plural, they got more than one, suggest that there's no emerging downturn at present. I'm pretty certain we said the same thing. Federal Reserve, I remember, wasn't it Bernanke? We don't see anything materially affecting the economy. And then all of a sudden the housing thing went down. And old Bernanke had egg on the face big time. You don't think they're doing the same thing here by chance, do you? But then there's the housing bubble, household debt, and the banks that have funded this bubble and that households owe this debt too. The charts below are from the report. Oh, I'm not going to share it with you. I love you, but don't worry about it. I got you covered. I'll voice out what's happening, okay? The charts below are from the report. The first chart compares inflation-adjusted house prices of the two most magnificent housing bubbles, Australia, red, and Canada, green, Spain, especially, or ESP, whatever, and the US. The index measures changes in price levels adjusted for inflation. Clearly, Australia and Canada are in a world of their own. But Spain, whose bubble collapsed disastrously and led to numerous bank resolutions and bailouts, actually got close. But I will tell you, Canada and Australia are on a planet of their own, if you want my opinion. And again, I'm looking at the chart 2007, 8, 9, 10. Everybody took a dump. All the lines took a dump. USA, Australia, Canada, Espanol, Spain, ESP. I like ESP better. Espanol, Spain. They all went like this and then back up. So, unfortunately, I guess Canada and Australia went ape shit up on their housing bubble. Anyways, the Australian and Canadian 2-decade-long housing bubbles made the old U.S. housing bubble 1 look practically infantile. However, with the U.S. housing market being so much larger, and with U.S. banks and financial products such as mortgage-backed securities being so interwoven in the financial world, the U.S. housing bust that morphed into the U.S. financial crisis became the global financial crisis. This is not going to happen with Australia and Canada. If they get into a financial crisis, they're not big enough to drag the entire world down. Australia's household indebtedness, mostly tied to mortgages, and mostly owed to the above four banks, reached 200% of net household disposable income, the highest ratio in the world. Even Canadian households can't keep up with that, and U.S. households after the financial crisis just fell off the mortgage wagon. I got to stop because I'm just kind of amazed that, what has it been, like 3 years ago maybe? Webbot starts talking about Australia, housing, watch it, pay attention, they're going to go through a collapse, the prices are going to crash because of this bubble, blah, 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 blah. And sure enough, it's beginning. It's happening. All this household debt has been incurred by households and provided by the banks on the assumption that the housing bubble would continue to inflate forever. Yeah, we thought the same thing too. Get a second mortgage, get a second house, get a second mortgage. You'll flip it. You flip the houses, dude. Or you move in a house, you fix it up, you flip it, and you move another house. You make 50, 60K. Oh, okay, yeah. So I can get an adjustable rate mortgage. It doesn't matter. Well, what if the rates go up? It won't matter. You'll be out of the house before the rates go up, dude. Oh, yeah, okay. All right, sounds good. Rates went up. housing crashed, you're stuck with 2 house mortgages, and you know the rest is history. I've done talked about it 1,000 times on this channel. But Snippy didn't take it lying down. I fought the law, and the law did not win, and the law being the banks. All this household debt has been incurred by households and provided by the banks on the assumption that the housing bubble would continue to inflate forever, but last year home prices began falling in Australia's 2 largest housing markets, with prices in the Sydney metro down 9% and prices in Melbourne down 6% by last month. That was never part of the plan. The OECD's chart below depicts house prices in the big 5 capital cities. It kind of reminded me of a song. It wasn't an 80s song. It was Pompeii. Wasn't it Pompeii? I was left to my own devices. It's about the capital, something about the cities. This city walls falling. How's that go? Mm-hmm. How's it go? Come on, Evelyn, you know these words. You got the best lyrics ever.
No voice. Singing.
Anyways, since I can't remember the line, we'll just continue so I don't waste your damn time. House prices in Perth, dotted line, again, you need to see it, have been in decline since 2014 due to the mining bust. The ongoing sell-off in Sydney and Melbourne is a welcome cooling of house prices, the report says, which also lists some factors that contribute to it. Prudential measures taken by the Australian authorities to halt the deterioration in lending standards. This includes limits on interest-only loans and many other measures. Oh, but what about the ones that are already out there that are going to end up failing? Well, we're not adding to that. So we've taken some good measures. Oh, okay, gotcha. A sizable pickup in new housing supply, with new construction now flooding both markets at a record pace. Again, I'm pretty sure end of 2005 and 6, we get housing market in America is booming. We also had a construction boom. Houses, condos, these things were selling before they could even build them. That's funny, right? It's amazing when you see things and you learn things, you educate yourself and you see cycles and all these things, you can just sit back and watch history repeat. And hopefully don't get caught in the middle of it and learn your lesson and say, you know what, I'm not doing that next time. Because if you do the same thing over, you're doomed to repeat history. A fall off globally in the appetite for housing in as an asset class, which may, without naming names, refer to the sudden loss of appetite for Australian housing among Chinese investors. Oh, so they were in Canada, California, America, in Australia too. Well, those Chinese are putting that money everywhere. Guess they done cooled off a little bit, huh? Domestic rule changes and alterations to state-level taxes that may have deterred some foreign buyers. Listen, if you have a country that's dependent on foreign buyers anywhere, that's not any kind of model I think I'd ever want in my equation. Like, let's put some laws in place that limit that like crazy down low. But the price declines haven't done anything to fix the situation. The OECD warns that though housing prices have eased recently, they remain high in level terms. They have more than doubled in Sydney, by the way, and Melbourne since 2005, even with the little blip we dealt with, okay? And this housing downturn is happening even as Australia's central bank has kept interest rates at a record low 1.5%, which stimulated the housing market until it didn't. First, the report holds out hope. The current trajectory would suggest a soft landing, but some risk of a hard landing does remain, but then it takes that hope away. Past OECD work has found soft landings are rare. Gotcha. So how will it impact the banks? The Australian authorities are in denial. The OECD seems to say ever so politely in between the lines, direct risk to the financial sector from mortgage defaults triggered, for instance, by a hard landing in house prices or interest rate hikes is viewed as limited by the authorities. For instance, see RBA 2018. RBA is their central bank. More denials from the authorities that encouraged this housing bubble to form in the first place. And here's a couple of points. A particular feature of the housing loan market is that it comprises mainly variable rate mortgages. You got to be kidding me. This makes household loan repayments more sensitive to movements in the interest rates. but that's not considered to be an issue. And risk of financial stress from the larger numbers of mortgages with interest-only phases that are due to transition to principal plus interest repayment is also not considered substantial. Nevertheless, here's what authorities should do after they get through with their denials, emphasis added. The authorities should prepare contingency plans for a severe collapse in the housing market. These should include the possibility of a crisis situation in one or more financial institutions. The contingency plan should include a loss-absorbing regime, including bail-in provisions, in the case of financial institution insolvency. Did you hear that quote? This is Australia. The contingency plans should include a loss-absorbing regime, including bail-in provision. What's a bail-in? Bail-in's when they take money out of your bank account and say, we had to fix the bank. We're not going to take it from future taxpayers. We're going to just take it from you now. Bail-in. And typically, well, FDIC insurance says if you have more than $250,000 in your account, let's say you had $350,000 and this little bail-in thing happened, we'll take the $100,000 out and leave you the $250,000. There's different ways that they mess with that. But anyways, continuing on. Again, tell me why cryptocurrency, having your wallet in your own possession, it's like having your bank account that you own at your own bank, right? What the hell does that? They can't go into your crypto wallet and do a bail-in. They could never do it. But you use a bank, right? You use a bank, PNC, Bank of America, your money, you've relinquished control of your money to some other entity. The IRS can, go after it. The government can seize it. They can do all kinds of stuff. But when it comes to cryptos, they can't. So you could see why this is going to ultimately be a good thing. You may not know looking at the prices right now, but just wait. So where was I? Insolvency, yeah. In case of financial insolvency, institution insolvency, despite the big four banks passing the stress test, they all passed. Passed the stress test. Oh, okay, great. Everything's fine then. The possibility of financial institution crisis should not be discounted entirely. So when this financial institution crisis happens, who should pay? The OECD explains, insured account holders will be fined. I was just saying this. This is incredible. I guess it's the same in Australia. For account holders, there is a deposit insurance scheme, the financial claims scheme. Wow, they even call it a scheme. Ours is called the FDIC, Federally Deposit Insurance, whatever corporation. Or Federal Deposit Insurance Corporation. Theirs is called the Financial Claims Scheme. This is not even a joke. Let me start over so I don't you're not too confused. Insured account holders will be fined. For account holders, there is a deposit insurance scheme, the Financial Claims Scheme, which provides protection up to a limit of 250,000 Australian dollars per account holder at each bank. But bank shares that a $341 billion in current market cap, senior debt, and uninsured deposits may be bailed in. As regards the institutions, a crisis would put recently passed crisis resolution legislation under test. Unlike the United States or the European Union, the legislation does not include explicit bail-in provisions as senior debt or deposits owed by financial institutions. This gives flexibility to adjust resolution plans to the specific characteristics of the crisis. On the other hand, the absence of explicit bail-in provisions could slow down the speed of resolution and risk encouraging financial institutions to gamble for resuscitation. APRA has indicated that it will start a consultation on its loss-absorbing capacity framework in late 2018. Well, it's an interesting time you would pick by chance. Cool. Loss-absorbing and recapitalization capacity should consist of a financial entity's equity or shareholders, as well as debt instruments, certain bondholders and uninsured depositors, that's normally you, on which losses can credibly be imposed in a resolution. Even if the banks don't topple, the report warns that the substantial impact of a hard landing in house prices on the wider economy may occur through other channels. If house prices collapse, consumer spending could suffer, be a negative impact on wealth, including from exposure to bank shares, which would encourage deleveraging. Together with reduced house-related expenditures, this would put pressure on the whole economy. A large drop-off in house prices could cut household consumption, prompt collapse in the construction sector, increase mortgage defaults, and freeze bank lending to business. In its own OECD bold, it states, financial supervisors and bank regulators should be prepared in the event of a hard landing in the housing market. And the RBA, their central bank, should hike its policy rates to remove the stimulus under the housing market. In the absence of negative shocks, policy rates should start to rise soon. Monetary conditions remain very accommodative, with the risk of imbalances accumulating further in the low interest rate environment if the low interest rate environment persists. In the absence of a downturn, a gradual tightening should start as inflation edges up and wage growth gains momentum. So a start to policy rate normalization is now firmly on the horizon. And though there are risks to this gradual tightening envisioned by the OECD, it could potentially bring welcome unwinding of the tensions and imbalances that have accumulated from the low interest rate environment, notably housing-related issues, which should have been done years ago, before the tensions and imbalances got so big that they threatened to trigger the next financial crisis. The house price declines in Sydney and Melbourne aren't exactly slow motion anymore. Read update on the housing bust in Sydney and Melbourne, Australia, which is another link, which I don't think I need. I think I just kind of covered that. But as you know, I'll put the link up for Wall Street. Gotta give them some respect. Take care.